What is going on, YouTube? My name is Matt Faircloth, and my company is called the DeRosa Group. And we are a real estate company dedicated to transforming lives through real estate. One way we do that is by putting out free education right here on YouTube for you and everybody else to check out. That is what I call an appreciation market. Put a pin in that. Appreciation versus cash flow. Increase revenue, decrease expenses. Do those, NOI goes up. People tend to liquidate in 2 to 5 years in those markets because it's like a hot potato. That's a good cash flow play, and cash flow investors rarely sell. Today's question is inspired by a program we do called Mentorship Monday. If you guys want to send us a question, email me at helpme@derosagroup.com. That is helpme@derosagroup.com. And I'll answer your question right here on the channel for you and everyone else to learn from. This is going to be a little bit of a longer conversation. This is about the future of multifamily. This is a deep conversation, deep question. Came in inspired by Alexander. Alexander is shooting in from Canada. Got a lot of Canada fans here at DeRosa Group and on this YouTube page, and that's all good. So thank you, Alexander from Canada. Things are about similar in some ways and very different in a lot of other ways to investing. I mean, the banking system is similar enough, but it's also very different. You still borrow money, but the terms to which you borrow money, the guarantorships to the way you borrow money, the way companies are set up are very different. Once you own with regards to rent increases and things like that are very, very different in Canada. So I'm not here to discuss the difference between Canada and the US. I just don't know enough about the differences between the two to feel like I'm educated enough to present that to you guys. So we're not going to do a Canada versus United States conversation today. Today's going to be the future of multifamily. And Alexander brings up a first issue is he lives in or near Toronto. And he's comparing the Toronto market as a place that he wants to invest. Now, cap rates, as he says in Toronto, are down into like the 3% range. In Canada, you can borrow money at 2.2%, a little bit lower than it would be here in the US in today's times. That 0.8% yield spread is not enough to make money. You're not going to make cash flow with money down and with expenses and with cost of capital, with amortization and things like that. So then Alexander starts talking about other markets that he may be able to drive to. Maybe should I drive here? Should I drive to Michigan? Should I go this there? And that may be too far to drive and the cost of travel, right? First of all, you need to research a lot of markets, guys. And so, yeah, Toronto might not work for Alexander because it seems like from what he's telling me here in this email, that market is at the precipice on increase and things like that. And that is what I call an appreciation market. Put a pin in that. We'll get back to it. Maybe he wants to seek more of a cash flow market. And those markets are out there, but that's going to be, markets maybe like in Michigan that like might find, I hate to say it, but markets like Detroit or something like that have kind of hit bottom and are on their way back up. And you might be in some areas where there's some crime and stuff like that, but markets that are recovering and then that you might be able to buy for a lower number. The cost of living is still high enough to where there's a spread you can make in reasonable cash flow in a cash flow market. That's a different type of thing. One thing I want to point out to you, Alexander, is you want to find yourself a cash flow market. There's tons out there where you can play the appreciation game. So before I move further, because the next conversation we're going to get into what's the future of multifamily with regards to cap rates going down. If cap rates continue to decrease and interest rates continue to decrease, then interest rates go up. The future, stay tuned on that one. We'll get to that in a minute, but I want to touch on this appreciation versus cash flow. If you buy a 3% cap rate property, automatically, you're not going to make a ton of cash flow, if any cash flow at all. Maybe you got to lay down a lot of money to even break even on a property like that. But unless Toronto goes absolutely upside down and goes to nowhere in a handbasket, Toronto is still going to maintain a 3% cap rate as long as interest rates stay low, or it'll maintain a favorable cap rate compared to the rest of the market because it's a desirable place to live. If you own a property in Toronto and you're able to increase rents by $50 a door or something like that, that $50 per unit per month goes a lot further in property value because your cap rate's lower. Remember, cap rate NOI divided by value, right? So if your NOI goes up a good bit, like goes up, $50 a unit per month, which is $600 per unit per year, take that and correlate it to your cap rate. If your cap rate's low, your price goes up incrementally more. It goes up double as much as it would in a 6% capitalization market, which there's plenty of 6 cap markets out there. There's going to be more cash flow markets. If you are looking to get in, add some value, and recapitalize through refinance, or even just sell and liquidate based on your new NOI, that's a great play to make in a place like Toronto. You don't want to do something like that in a place like Detroit. Using another example I just made, right? Detroit may be more of a cash flow market. And if you increase rents by $50, you'll get to enjoy that $50 in the hip national bank, AKA your pocket, but your property value is not going to go up a ton because you're not Toronto. Every dollar you increase in property income is going to go right to the bottom line and jack your value way up, as you would in a low cap property. So low cap markets are not a bad thing. You just got to know how to play them. The way you play a low cap market is to play appreciation. You cross your fingers and you hope that the cap rates stay low. You do whatever you can to get NOI up, decrease expenses, increase revenue. One of those two things. It's only 2 ways you can change NOI: increase revenue, decrease expenses. Do those, NOI goes up, property value goes way up because your new cap rate. You win, yay. You'll see people hold properties in appreciation markets less time. People buying in the US in Austin and Charlotte, North Carolina, Raleigh, North Carolina, Atlanta. People tend to liquidate in 2 to 5 years in those markets because it's like a hot potato. You've got it, you've increased the value, you've made lots of money for your investors. It's time to pass it on before those cap rates start going up and then all the profit you made goes away. Cash flow markets are more markets that you're going to get in, you're going to hold long term. You kind of don't care what the market does because you know that the yield spread between what you're paying in property value versus what the revenue you can get on well-leased units to good people are going to be. If you can make a nice arbitrage, a good yield spread there, make a good living on it, that's a good cash flow play. And cash flow investors rarely sell. But we're a cash flow investment company at DeRosa Group. We've done some appreciation plays, but we're mostly a cash flow company, and we try not to sell too often unless it's appreciation's kicked in and it just makes more fiscal sense for investors. That's what you want to look for, Alexander. For all the language you're talking about here is you want to find yourself a buy and hold market, because it sounds like you want to be a cash flow investor that might not be anywhere near you. And so you might need to search down into the US a bit further, into the lower 48, or into, whatever nickname you guys have for us there. There's plenty of cash flow markets across the United States that you can find that are not Toronto, that are not 3% cap rates. Okay. You've done your homework, my friend. And I'm not going to argue with you on your homework. His question is, what if cap rates start to increase? Because cap rates are really based on interest rates. The reason why cap rates are at 3% is because money is so cheap. And the lower interest rates go, if we go to zero, if we go to negative interest rates, cap rates will just follow right along and chase that down. And there'll be a spread above what you can borrow money at and what cap rates are. It's called, like yield spread is a term that people use for that. That is something that you'll see until rates go up to 4, 5, 6%. And the Fed's already talked about raising rates. People are talking about inflation, things like that. So rates may start to creep up again, and that will push up cap rates, right? But here's the thing. This should not be a reason for you guys to stay out of multifamily. You might want to stay out of smaller real estate, but staying out of multifamily, it's not going to hurt you if these things happen. Well, why? Let's talk about that. If the Fed starts increasing rates, it's because there's inflation. It's because there is cost of goods is increasing. Look at the cost of a gallon of gas today versus what it was a year ago. Look at labor cost. Look at all these different things. We're starting to look at lumber, this whole lumber crisis that just happened. We're seeing a lot of increases in goods. And the one thing that you'll note, guys, it's got nothing to do with how much money the Fed's printing. That's got nothing to do with any of the other underlying factors that cause inflation. Inflation is a supply and demand thing. And for the first time ever, and since a lot of our lifetimes, we're seeing a lack of supply. You just can't get things. And think about the last time in the last 15 years, it was like, well, we just can't get, that's on back order. And you just can't get somebody to come to your house to do work, or you can't get an HVAC unit, or you can't get a refrigerator because they're sold out or because it's stuck in the Suez Canal. COVID has caused a major downward pressure on the supply chain. There's still demand, but because there's more demand than there is supply, that drives prices up. The intersection of supply and demand, the intersection of those two lines is your price. And because supply has gone down, demand stays the same, prices are going to start to go up. That's why we're going to see inflation. And the Fed is going to start to increase rates to combat that. But if inflation happens, our rents are going to increase along with it. And that's not going to be this seamless straight line thing. It might be painful for a little bit, where our cost of materials are going to go up and we'll have to start increasing rents to get there. And then wages will have to go up for people who can afford the rents. But eventually, give it a couple of years, give it some time. and NOIs will catch up and pull up. And we then make more money as landlords if there is inflation and if it causes everything to go up, including our rents, because it's going to cost our cost to go up, but it'll also cost our rents to go up, which will drive up NOI too. That's why I believe inflation is not necessarily a bad thing. These are the rules. I didn't make the rules. So if these are the rules, you got to buy assets to protect yourself against inflation. So if you're watching this and you don't own any assets right now, I strongly recommend you find a way to get yourself into assets that will go up in an inflationary economy, like real estate, gold, silver, crypto, things like that. So get yourself into those kinds of things. We're a real estate company, so I don't do any of those other things I just said. I just do real estate. So that's what I recommend to you, Alexander. Longer conversation today, guys. So I hope this is of value. Again, help me at DeRosaGroup.com if you got questions you want me to answer here on the YouTube channel, or if you'd like to just shoot some thoughts for us to consider for videos for everybody to watch here. DeRosaGroup.com/insiders, where you can learn from us and interact with us directly and my team. So that's what I got for you today, guys. Thanks for watching. Have a great and profitable week. Smash the subscribe button, like this video, leave a comment. We'd love to hear from you guys. We'd love to have you guys as a try it again. Love to have you guys as a subscriber. Why can I not say that word? And we'd love to have you guys okay. We'd love to have you guys as We'd love to have you guys as subscriber. We'd love to have you guys as a subscriber. I can't say it.